There we go. Hi everyone, welcome back to another webinar from Jackson Securities. I'm your host for today. My name is Jonah and we're joined with Mark and Amanda from Qualitas. Before we start, if you have any questions, feel free to submit them throughout. There'll be some time at the end where they'll be answered. And just a bit of a disclaimer beforehand as well, this is only for information purposes only and shouldn't be taken as advice. But passing on to Amanda or Mark, take it away.
Thank you everyone for joining today's exclusive webinar presentation on the Qualitas Real Estate Income Fund, otherwise known as QRI. My name is Amanda Lambert and I'm the Director of Wholesale Advisor Distribution here at Qualitas. I'm delighted to be joined by my colleague Mark Power, a commercial real estate or CRE debt specialist and head of Qualitas Income Credit Funds. Today's session will be followed by a Q&A session, and as Joan has alluded to, please feel free to send your questions through and we'll do our best to answer those in the time allocated. Just a look at what we'll be talking about today. The main presentation will cover three topics: a brief introduction to Qualitas, the market opportunity for the commercial real estate debt market, an overview and portfolio update on the Qualitas Real Estate Income Fund, a listed managed fund on the ASX with a ticker code QRI. So a little bit about the manager and about Qualitas. Qualitas is one of the largest alternative real estate investment managers here in Australia with extensive industry experience, both institutional grade governance and a stellar track record. We currently have funds under management of approximately 5.8 billion across private equity and private debt. And as you can see on this slide, 71% attributed to credit and 29% to equity opportunities. Since inception, we've undertaken in excess of 219 investments, and of this amount, approximately 172 investments were specifically in private credit. The remaining transactions are in the nature of equity investments. Our equity skill set brings a unique and beneficial lens to our due diligence as a lender, which is reflected in our track record of no loss to investor capital since inception 14 years ago. I'm now going to pass over to Mark, who will go into the commercial real estate or the CRE debt market opportunity.
Thanks, Amanda. What I'd like to talk to today is about CRE or commercial real estate private credit. It's essentially private debt, and why we at Qualitas are such a strong advocates of this market. And I think this slide actually summarises it really well. If you look at, and it's all around the size of the addressable market. So if we look to the size of the traditional market for commercial real estate debt in this country, it's around about $414 billion. And that market has been growing over the course of the last 10 years at a compound growth rate of around about 6%. Whilst the market's been growing at 6%, the traditional ADIs and banks have only actually been growing at a compound rate of 3%, so giving up significant market share over that period. So if we wind the clock back, say, 10 years, the major banks had 86% market share in this space. As it's today, they're at about 74%, and it continues to reduce. So we look at Qualitas as a business where we've got a debt exposure of circa 4 billion, representing only 1% of the broader market share. And if you look at the non-bank or alternative sector more broadly, the market share is still sub 10% across the board. So we look at it as a market with enormous potential, with the traditional lenders actually giving up market share in that space, and this emerging alternate or non-bank sector really filling the void in the marketplace that's being created by the banks retracing from the sector. And the reason they're retracing from the sector, it's all regulatory driven. Post GFC, APRA, which is the national regulator of the banking system, wanted to shore up the system, and one of the ways in which they chose to do that was to essentially encourage, if you like, the banks to reduce their exposure to commercial real estate and not just in absolute terms relative to the size of their book, but also in terms of the nature of what they can lend to. So now what they lend to is quite a narrow sandbox that then provides plenty of opportunity for alternate lenders to enter that market and get what I'd consider to be outsized returns for the risk that we're actually taking on board. So that's on the deployment side of things on the market. The other side of the equation, which is always a very important equation for Qualitas, is the actual capital that we raise, because we're a real estate funds manager. So we raise a majority of our capital off institutional investors, largely offshore sovereign wealth funds and pension funds. And what we're finding those, and then we obviously lend that money out to the borrowers in the Australian marketplace. What we're seeing from our institutional investors is a really strong appetite to increase their exposure to QRI debt in the Australian market. And on screen there on the right-hand side, you'll see that middle bar chart, which actually highlights a survey that was undertaken by Preqin amongst institutional investors, and what they're telling us is that they intend to increase their allocation to private credit, or 67% of them are looking to increase their allocation to private credit, which is a very substantial number. And what we're finding when we're talking to and engaging with those investors is that they may have previously been more equity real estate investors, and now they're saying, look, you know what, if I can get IRR returns in the high single digits in the debt space, which is pretty close to what I'm getting in the equity space, I'd prefer to be directing capital toward debt. Moving on to the next slide. So this slide here is actually showing what we mean by when we're saying commercial real estate debt and where it actually ranks in the risk return spectrum. So essentially, what we like and what investors like about debt is that it's always basically got it's always first cab in the rank, if you like, in terms of the income flow coming out of any property, and also when that property is realised, you're getting first go at the capital that's coming out from that sale. So from a risk point of view, it's very much at the lower end of the risk spectrum as compared to equity, which is at the higher end of the risk spectrum, because of the fact that equity gets paid last in terms of income stream coming out of a portfolio, and any value decline in an asset is obviously worn by equity well before the debt is placed in any form of jeopardy. Then on the right-hand side of the screen there, you've got a bit of a risk return curve to show where private QRI debt actually sits on that. So obviously TDs and government bonds are down the very low risk end of the market, corporate bonds and bank loans, and then private credit comes in. So it fits sort of midway through the risk spectrum and is considered certainly lower risk than subordinated debt hybrids and equity, such as investment in A-REITs. Moving on to the next page.
Thanks, Mark. So I'm just going to take you through a little a snapshot and overview of the Qualitas Real Estate Income Fund, as we alluded or as we've stated. In the ASX ticker code is QRI. We're proud to actually, we're proud because we are the first and only mortgage real estate investment trust known as an MREIT listed on the ASX, and the first MREIT in Australia. These opportunities are very prolific in the US market, but we are the first entity to bring such an opportunity to Australia. So QRI has funds under management of 550 to 600 mil, and we report on our NAV every week. The fund aims to target RBA cash rate +5 to 6.5%, and we are well within this current range on a 12-month basis. As at February, we delivered an 8.2% annualised distribution return based on a NAV of $1.60. 40 loans underpin the QRI portfolio, and just a couple of the investment features is that we're an experienced institutional local-based manager. QRI provides regular monthly cash distributions. Return is at a premium to cash rate. The potential of capital preservation from loans secured by real property mortgages. You get exposure to the property market on the credit side, not on the equity side. And there's a simple credit strategy of investing in only commercial real estate loans. The fund is on every major platform and has several ratings, including a recommended rating from Zenith. You can access the rating reports and research from our website.
Thanks, Amanda.
Thanks, Mark.
Yeah, right. Thanks, Amanda. I'll now talk briefly to what the portfolio looks like. And maybe just before I go there, one of the points I did want to highlight as well, whilst the return for February on an annualised basis is 8.2%, that as a return's got significant tailwinds in behind it in terms of still interest rate rises to come through, but also some widening credit spreads that we're seeing in the marketplace at the moment, whereby they're increasing by, I'd say, about 75 basis points over the course of the last 9 months. But on the portfolio composition and what that actually looks like, you'll see there $600 million fund. The broad asset categories that we lend into, pre-development land loans are around about 40% of the fund. Construction loans are around about 25% of the fund, and then we have investment loans, which will generally hover around about 30% or thereabouts. You'll see the sort of loans that we do, they're predominantly senior or first ranking loans, so 84% of the portfolio is senior, and 16% of the portfolio are mezzanine loans. So when we say mezzanine loans, they're essentially second ranking mortgages on projects, generally sitting in behind major banks. As far as the sectors that we lend into, we heavily tilt into the residential sector, and the reason we do that is that we just feel it's the deepest, most liquid, and clearly the most defensive sector in the commercial real estate market. So when we're talking residential, that's largely medium and high density apartment development. And our view around that residential market is whilst there's some noise at the moment about values coming back, and that's really a bit of recalibration in the detached housing market after it ran very, very, very hard over COVID. So median house prices increasing circa 28%. So we're seeing a bit of that knocked off the top. But if we look at the strength of that sector moving forward, which is underpinned by very, very low vacancy rates, very strong demand for dwellings and inadequate supply, we think the thematics around continuing to invest in the residential sector through debt are compelling. From a geographical point of view, the fund is very New South Wales, Victorian centric. You'll see there 80% of the portfolio is in those two major, most liquid markets. And if we look at the investments across purely Sydney, Melbourne, Brisbane, that accounts for circa 87% of the portfolio. Our average weighted LVR across the portfolio is 66%. So what that means is that on an average weighted basis, you've got 34% equity relative to the value of the property, protecting the debt investment. So I thought I'd just elaborate on that whole debt and to equity piece a little more, and how that sort of translates through to pricing of QRI. So QRI was listed at $1.60. Its NAV remains at $1.60 and has done since inception essentially for 5 years. So if you then overlaid that with the average LVR, loan to value ratio, that runs through the portfolio of 66%, what that essentially means is that on an average weighted basis, for you to write off any of your NAV, so for that NAV to fall below $1.60, you essentially need to be, on an average weighted basis, be writing off 34% of the capital value of a loan. So if you've lent on a property which has a value of $10 million, and you've done you've got a loan there of $6.6 million, the value of that property has to fall from 10 mil to 6.6 mil before your NAV is placed at risk. And it's often something which isn't properly understood in the market for a stock such as QRI, because people think of QRI as a real estate stock. And it is a real estate stock, but it's a real estate debt stock, not a real estate equity stock. So in times like these, where you've got rates increasing, that's great for debt because it gets passed through to the investor. And where in the event that you do have some valuation pullback in certain asset classes, you're very well protected by virtue of the equity buffer. Now, where this becomes more interesting again, particularly for QRI at the moment, is where QRI is trading. So notwithstanding the fact that the NAV is $1.60, and in the ordinary course, that's where you'd expect it to trade around about those levels, assuming that every dollar that you lend out is still worth $1 and it's fully collectible. But what the unit price has been trading at around about $1.50 in recent weeks. As of yesterday, it sort of dropped down to $1.47 or thereabouts. So assuming that you're saying the market's accepting of the return, which is sort of 8.2% on an annualized basis and increasing, what the market's actually saying is that they believe, if you look at the $1.47 number, for instance, what would have to occur for NAV to come back to that sort of level and place the investment at risk is one, that 34% equity buffer would need to diminish, but then a further 8% would need to diminish. So what the current unit price is saying is that it's basically saying that we believe there's going to be a 42% reduction in the value of commercial property, which no market commentator is forecasting that to occur. We're certainly not forecasting that to occur, but that's the implication if you run that through the QRI share price at the moment. So I thought that was just a worthwhile thing to touch on. Moving on.
Thanks, Mark. So now I thought I'd just share with you why we think it's a great time, or why it could be a good time to invest in QRI. So I'm going to comment on various factors as to why now is the right time to consider an investment in QRI. The yield calculation that we've talked about is 8.2% per annum as reported in February, and it's based on the last 12 months NAV of $1.60. Secondly, QRI carries no leverage, which means no debt. So any increase in interest rates, to the extent that this occurs, then 100% of those increases flow through to our investors. Thirdly, we're all currently experiencing an environment of widening credit risk margins. So not only do interest rates continue to increase due to the cash rate increases, but the risk margin is anticipated to also increase, and which in the ordinary course should lead to greater returns for our investors. The fully secured portfolio has an average loan to value ratio of 66% with a maturity profile of 1 year, allowing for frequent revaluation of security and reassessment of returns. We review our loans on a monthly basis and can report that the loan portfolio is performing with no impairments recorded and no interest in arrears. And this continues to result in a stable NAV. We haven't touched on the warehouse facility, but there is a warehouse facility in place for QRI, which has an accretive basis of around 1% when a transaction is in place in the warehouse. Basically, what that means, it allows us to have no cash sitting idly in the portfolio, and allows us to move on opportunities as they present themselves, and as loans are repaid into the QRI portfolio, those loans are in the warehouse are then brought into the QRI And again, that results in a probability of a higher portfolio return for our investors. Wanted to, just by way of wrap up, I'd like to make the following salient points regarding QRI. Firstly, the combination of rising interest rates, rising risk margins, and the short duration of our loan portfolio, with 81% of that variable rate loans, which provides an immediate ongoing and an effective basis to achieve higher returns for QRI. We expect that the variable rate loans will increase to around 90% come June 2023, again resulting in higher returns for our investors. QRI has a track record of delivering stable monthly returns and with no loan impairments to date. The manager continues to see a dynamic CRE or CRE debt market, and we're experiencing strong pipeline for its transactions. The utmost importance is we remain vigilant with our asset reviews, which we will continue to undertake on a regular basis. Overall, whilst we understand that the current period of interest rate and inflation recalibration can be unsettling for investors, especially in times of systemic equity market risk, it does represent an exciting environment for credit funds, as it provides an ability to reprice both base rates and risk margins. Now, in the ordinary course, short-dated property loans are fertile assets to provide a rapid response, allowing investors to reap the benefits of this new set of dynamics. As managers of this portfolio, from a pricing perspective, the current dynamic provides more pricing growth relative to a highly liquid price setting, which has dominated the market for the previous 10 years. I'd like to thank you all for your time today, and would like to remind you that if you have any questions, we ask that you please input these into the chat function, and we'll try our best to answer them. Just to recalibrate this, there's a general advice nature, and no personal circumstances have been taken into consideration in this presentation today. And again, so thank you for your time, and what we're going to do now is move over to Q&A.
Yeah, thanks very much, Amanda and Mark. Sounds like a very exciting opportunity for QRI. Just some questions. Could you give some further colour on the timing of index inclusion and the incremental demand in QRI that's expected if it gets included in the ASX 300 and the ASX 300 A-REIT?
Yeah, sure, happy to. So the reweighting of that occurs on the 1st of September of this year. So there's the ability for QRI to then be incorporated within both those indices that you've just mentioned. There's a couple of key criteria that we need to achieve in order to meet that inclusion. One is around the adjusted free market cap of the actual stock. So that has to be sort of 274 or better. Now at the moment we're around about 250, so we're pretty comfortable that we're going to hit that particular hurdle. And the other hurdle is around average daily liquidity volume in the stock. So we're about 90,000 short on that on a daily basis at the moment. So it's a key focus of us as manager to ensure that we get that daily liquidity piece up over the course of the next 6 months to maximise our chances of being included in those indices. In the event that we are, it will create substantial demand for QRI, just given the sheer scale of funds that actually track the index. To give you an idea on just if you look at one particular fund being the Vanguard Property Securities Fund, which or A-REIT fund, which tracks the 30 A-REIT stocks in the ASX 300. Now, given the size of that fund, in the event that we were included, that would require them to acquire circa 24 million units in QRI. That's just one fund alone. So that we believe that the demand for the stock would increase substantially in the event that we are included in those indices.
Yeah. So can other listed LITs be included in the indices as well?
Not as it currently stands. I mean, the reason we've got the opportunity to be included is that we've been classified as an MREIT or mortgage REIT, and we've been able to be included for that reason because of the fact that all we do is invest in commercial real estate loans, essentially. So it's a very focused investment strategy, whereas the majority of the other lits and licks in the marketplace are more diversified in terms of their approach. They might have a bit in bonds and a bit in equities and a bit in real estate debt and the like, which doesn't actually allow them to be classified as an MREIT.
Yeah. So let's talk about the objectives of the fund, and how is Qualitas tracking and achieving these?
Yeah. So the key objective for us on a fund size is targeted return to the investor. So that the target return, as Amanda mentioned earlier, is 500 to 650 basis points over the Reserve Bank cash rate. Since inception, we've been tracking at about 5.07%, so pretty much tracking in accordance with that. And as we sit here today, we're sort of in that lower end of the band as well, and expect to continue to be at sort of that 500 plus over the Reserve Bank cap rate. Another important objectives for the fund is around capital preservation for our investors. And as I mentioned earlier, the NAV on the stock continues to remain at or above $1.60, and we review that weekly. So a significant focus is on ensuring that capital is preserved. Diversification is also a very important part of our broader objective. So that we provide the investor diversification, not just on borrower, but on asset sector, whether it be residential, commercial, industrial, specialised, together with geographic spread across the portfolio.
Yeah, good. And I'm sure you've seen with elevated volatility in the market, capital preservation, it's one of the key considerations for investors. What are the key success factors that enabled Qualitas to deliver these objectives for investors?
So the key success factors are around about, for us, it's what we consider to be best in class underwriting capacity and asset management. So we go through a very, very rigorous process before we bring loans on book. And if I compare that to my background, I've been with Qualitas now for 6 years, but prior to that spent 27, 28 years in the major banks in their corporate institutional real estate teams. And if I compare the amount of due diligence we do compared to what's done in the major banks, it'd be 2 to 3-fold in terms of when those investments are first made. And then from an asset management perspective, that's also a very rigorous process. So we look at every single loan. Every single month, the investment team prepares an updated report on each of those loans. That gets escalated to myself as head of fund, also gets escalated to our head of transactional risk within Qualitas, and we then look through those together, consult on those, and if we think there's been a change in risk profile, it gets elevated up to a monthly fund performance meeting, which is attended to by the executive of Qualitas. So it's a very rigorous underwriting asset management process, which we think is best in class, which stands us in very good success, in very good space from a success perspective. Also, the experience of the actual team that we have within Qualitas. So the leaders in our real estate team have between sort of 20 and 30 years experience investing in both equity and debt in the real estate space. So a very experienced team, but also quite deep as well, with 29 in real estate investment professionals within the investment team.
Yeah, excellent. And in the current market, what are the key risks for the portfolio, and how do you manage those risks?
Yeah, so the key risks for us at the moment are it's really around interest rates and how our investments are going to react to that. So there's a couple of points that spin off the back of an increasing interest rate environment. One, you say for investors is actually a really good thing because they get an increased return because, as Amanda mentioned, 80% of the portfolio is priced off the variable rate, so that flows straight through to them. So that's essentially a positive as far as that goes. So I've just lost the train of thought. The question again?
Yeah, the question again was, in the current market, what are some key risks for the portfolio, and how do you manage those risks?
Yeah, so that the interest rate piece, good for investors, but we also need to be mindful of the ability of the borrowers to continue to service their exposure. So for us, when we write the loans in the first place, we're really conscious of the liquidity and cash flow of a particular borrower. So we try and kind of break that cash flow as best we can. So we push out forecast revenues, we pull forward forecast expenditures, we increase interest rates, we assume certain levels of defaults on sales and the like. So in the event that we can break that cash flow, we just don't do the deal. So we're only lending to parties that have already got very strong liquidity within their group. So what we find in times like this, when interest rates are increasing, that can be withstood. The other piece is around increasing interest rates, what that means for asset values. So ordinarily speaking, that can place pressure on asset values in an increasing interest rate environment. So we're very mindful of that. We have regular valuations of our assets. Whenever we do a new loan, we get a valuation. If we restructure or extend, we get a fresh valuation. And we have the right to revalue our assets at any point in time during the tenure of the loan. But fundamentally, because we're in the debt stack here rather than the equity stack, if property values sort of pull back by 10% or thereabouts, that's equity risk rather than debt risk, because as I mentioned earlier, we're still well and truly protected within the broader capital stack.
Yeah, good. So what does it take for QRI's loan portfolio to start to be impaired? For example, where the loan balance actually exceeds the value of the property securing the loan.
Yeah, so that's kind of the example that I ran through a little earlier. You really need a very, very significant pullback in asset values for a loan to be impaired. And the example I provided previously, where on an average weighted basis, there's a 34% equity buffer across the portfolio. So you, on a weighted basis, you really need to see property value coming back by that 34% mark before it started placing pressure on the NAV within the fund.
Yeah. So is this a likely scenario in the current market, or not likely?
Yeah, I mean, I would have thought it's really unlikely. I mean, no one's forecasting prices to come back by 34%, and it would take a fairly cataclysmic event for something like that to transpire.
Yeah. So this is where I think the market isn't behaving rationally. You know, at a current price of $1.50, QRI will need to write down 34% equity buffer, plus another 6% current discount to the NAV, obviously implying that commercial real estate value falling by 40% in less than a year. Also, my understanding is majority of the portfolio is secured by personal guarantees in addition to that underlying property securities. So the current unit price implies 40% fall in commercial real estate in less than a year, and also you couldn't recover a single dollar from the personal guarantees as well. It just doesn't make sense.
Yeah, spot on. Yeah.
Yep.
It's a nice summary of the position.
Yeah, good. So what are some opportunities and upside you see for QRI investors in 2023?
Yeah, so the opportunities are broadly around returns. I mean, we're in a highly uncertain environment. There's a whole lot of pressure around equity valuations at the moment, what's going to play out there. So for us, for an investor, investing into the debt stack of real estate, we do have that equity buffer. In a rising interest rate environment, when you're looking at the February annualised return at 8.2%, and there's still significant tailwinds in behind that as well, I think this provides a really strong return to investors. At the same time, the market itself is providing us with really good opportunities to invest in, because in these times of uncertainty, what we actually find is the banks retrace a little bit further in terms of risk appetite. Some of the smaller non-banks and alternates, their capital sources dry up, so a bit of liquidity is removed from the sector, which enables the quality of our deal flow to improve even further, and enables us to get a better return on that. So I kind of look at QRI in the current market as sort of cheating the risk return curve a little in terms of what sort of return you can get for the risk that the fund's actually taking on board.
Yeah, great. Well, thanks very much, Mark and Amanda. I think that's all the questions we have time for today. Just before we finish, is there any final words you'd like to leave with the investors?
Amanda, maybe over to you.
Yeah, thanks, Mark. Thanks, Jonah. Look, I think I just really wanted to again thank you for your time and consideration in joining this webinar today. We have gone through a number of the reasons why QRI could be a really good investment and a defensive investment in your portfolio. So if you are looking for regular income and with some protection by asset-backed securities, we do encourage you to have a look at QRI and to perhaps look at what role it could play in your income. Your income requirements, both works well on a self-managed super fund set and forget, but it's always nice to have an income that's outperforming your cash rate and what is also available out there, but also having that guarantee of some asset-backed securities. So thank you.
No worries at all. Thanks very much. Thank you everyone for attending. This has been another webinar from Port Jackson Securities. See you all the next one. Take care.
Thanks all.